If you're over 65, stop what you're doing right now. HMRC is about to send out charges that could cost you up to £2,500 in 2025, and most pensioners have no idea this is coming. This isn't clickbait. This isn't scaremongering. This is happening right now, and if you don't take action in the next few weeks, you could be one of the thousands of retirees hit with a devastating tax bill. In the next few minutes, I'm going to reveal exactly what's happening, who's at risk, and the three things you must do immediately to protect yourself. Whatever you do, don't click away until you've heard warning sign number 2, because that's the one catching out the most pensioners. Welcome back to UK Pension Hub, the channel dedicated to protecting your retirement income and making sure you keep more of your hard-earned money away from the taxman's grasp. I'm here to cut through the confusion and give you straight talking advice about pensions, tax, and retirement planning. If you're new here, hit that subscribe button and ring the bell so you never miss a crucial update that could save you thousands. Today we're tackling something that's causing serious anxiety among the over 65 community, and frankly, it should be getting more attention than it is. HMRC, that's Her Majesty's Revenue and Customs for anyone unfamiliar, is ramping up enforcement in 2025, and they're targeting areas where pensioners commonly make mistakes. We're talking about charges, penalties, and back taxes that can add up to £2,500 or more, and they're not being lenient about it. Now, I know what some of you are thinking. You've paid your taxes all your life, you're a law-abiding citizen, and you've never had problems with HMRC before. That's exactly why you need to watch this video, because the vast majority of pensioners who are getting hit with these charges aren't tax dodgers or criminals. They're honest people who simply didn't understand the rules or didn't realize that their circumstances had triggered new tax obligations. So grab a cup of tea, get comfortable, and let's go through everything you need to know to protect yourself from these new HMRC charges. Trust me, the 20 minutes you spend watching this video could save you literally thousands of pounds. Let me start by explaining what's actually changed and why 2025 is the year you need to pay attention. HMRC has been quietly upgrading its digital systems over the past few years, and they're now incredibly good at cross-referencing information from different sources: banks, building societies, pension providers, employers, rental platforms, even overseas tax authorities are all sharing data with HMRC automatically. This means that income you might not have declared, whether by mistake or because you didn't think you needed to, is far more likely to be discovered. The charges we're talking about aren't a single new tax. Instead, they're penalties and interest charges that HMRC applies when they discover undeclared income or unpaid tax. The £2,500 figure represents the kind of bill that pensioners are facing when multiple years of mistakes catch up with them all at once. Let me break down exactly how this happens. First, let's talk about undeclared pension income. This is the single biggest issue affecting over 60s right now. Many of you will be receiving multiple pensions. You've got your state pension, maybe a workplace pension from your career, perhaps another pension from a different job, and maybe even a personal pension you set up years ago. Each of these is taxable income. The state pension is paid gross, meaning no tax is taken off before you receive it. HMRC usually collects the tax by adjusting the tax code on your other pensions, but this system isn't perfect, and errors happen all the time. Here's a real-world example. Let's say you're receiving a state pension of £11,500 a year, and you've got a private pension paying you £15,000 a year. Your total income is £26,500. After your personal allowance of £12,570, you should be paying tax on £13,930. But if your tax code hasn't been set correctly, you might not be paying enough tax throughout the year. When HMRC realizes this, they'll send you a bill for the underpaid tax, plus interest, plus potentially a penalty if they think you should have known there was a problem. Now let's talk about pension withdrawals, because this is absolutely crucial if you've accessed your pension using the freedoms that came in back in 2015. When you take money out of your pension pot, whether it's a lump sum or regular withdrawals, this counts as income for that tax year. The first 25% is usually tax-free, but the rest is taxable. Your pension provider will deduct some tax using an emergency tax code, but this is often wrong. If you've taken out a large lump sum, you might have been massively overtaxed or undertaxed, and it's your responsibility to sort this out with HMRC. What catches people out is that if the withdrawal pushes you into a higher tax bracket, or if you're now required to complete a self-assessment tax return because of the withdrawal, and you don't do this, penalties start racking up. The penalty for filing a tax return late starts at £100 and increases the longer you leave it. If you're several years behind, you can see how quickly this adds up. Interest income is another major problem area, and this has become much more significant over the past 2 years as interest rates have increased. Many pensioners have savings accounts that are now paying decent interest rates for the first time in over a decade. You have a personal savings allowance, which is £1,000 if you're a basic rate taxpayer, or £500 if you're a higher rate taxpayer. If you earn interest above this amount, it's taxable, and you need to declare it. Here's the issue. Banks and building societies used to deduct tax automatically from your interest, but they stopped doing this years ago. Now, the responsibility is entirely on you to track your interest and declare it if it's above your allowance. With better interest rates, many pensioners are crossing that threshold without realizing it. If you've got £30,000 in savings and you're earning 5% interest, that's £1,500 a year. If you're a basic rate taxpayer, £500 of that is taxable. If you're a higher rate taxpayer, £1,000 is taxable. Multiply that over 3 or 4 years of not declaring it, add penalties and interest, and you're looking at a substantial bill. Investment income is similar. If you own shares or investment funds, you'll be receiving dividends. The dividend allowance for 2024 to 25 is just £500, which isn't much at all. Anything above that is taxable at 8.75% if you're a basic rate taxpayer, or 33.75% if you're a higher rate taxpayer. Many pensioners have built up investment portfolios over their working lives, and they're now generating dividend income that needs to be declared. If you're also making capital gains by selling investments, and these exceed your annual capital gains exemption, that needs to be declared too. Rental income is a massive area where pensioners run into trouble. Maybe you're renting out a property you used to live in, or you've invested in a buy-to-let, or you're even just renting out a room in your home. All rental income must be declared, and you need to complete a self-assessment tax return. You can deduct certain expenses like repairs, maintenance, and letting agent fees, but you need to keep proper records. The Rent-A-Room scheme lets you earn up to £7,500 tax-free if you're renting a room in your main home, but you need to actively claim this relief. Many people don't know about it and end up paying more tax than necessary, or worse, they don't declare the income at all and face penalties when HMRC finds out. Here's something that surprises many grandparents. If you're receiving child benefit for a grandchild you're caring for, and either you or your partner has income over £60,000, you need to pay back some or all of that benefit through the High Income Child Benefit Charge. This requires completing a self-assessment tax return. Many grandparents who've stepped in to help raise grandchildren have no idea this rule exists, and HMRC has been actively pursuing these cases. Let me give you the numbers on penalties, because understanding these is crucial. If you fail to notify HMRC that you need to complete a tax return, the penalty depends on how much tax you owe and how late you are. For a careless error, the penalty can be up to 30% of the tax owed. If HMRC thinks you were deliberate in not declaring income, the penalty can be up to 70%. If they think you deliberately concealed income, it can be up to 100%. On top of this, you pay interest on the unpaid tax from when it was due, and this compounds over time. Let's do some real numbers. Say you failed to declare £5,000 of interest and dividend income each year for 3 years. At a 40% tax rate, that's £2,000 of tax per year, or £6,000 total. Add a 30% penalty for carelessness, that's another £1,800. Add interest at around 7% per year on average across the 3 years, that's roughly another £600. Your total bill is now £8,400. This is how pensioners end up with bills of £2,500 and upwards, and some face even more. The scary thing is that HMRC's automated systems are now catching these issues automatically. They receive feeds from banks showing your interest, from investment platforms showing your dividends, from pension providers showing your withdrawals. They match this against what you've declared, and when there's a mismatch, they open a compliance check. You'll receive a letter saying they've identified a discrepancy and asking you to explain. If you don't respond quickly, or if the explanation isn't satisfactory, penalties start being applied. So what do you need to do right now to protect yourself? I'm going to give you a clear action plan that you can start implementing today. Step 1 is to gather all your financial information for the current tax year and ideally the past 4 years. Get statements from every pension provider, every bank account, every savings account, every investment account. If you have rental properties, get your rental income records and expense receipts. Make a comprehensive list of every single source of income you have. Include everything, even if it seems small or insignificant. Step 2 is to calculate whether you have any undeclared income. Add up all your income sources and compare this to what's been declared to HMRC. If you've been completing self-assessment tax returns, check them against your actual income. If you haven't been completing tax returns, check whether you should have been. You need to complete a self-assessment if you have untaxed income over £2,500, if you're self-employed, if you have rental income, if you have substantial savings or investment income, or if HMRC has specifically asked you to. Step 3, and this is crucial, if you discover you have undeclared income or unpaid tax, come forward voluntarily. Do not wait for HMRC to contact you. HMRC has several disclosure facilities that allow you to put your affairs in order with much lower penalties than if they discover the problem themselves. The digital disclosure service is available online for most situations. For more complex cases, there's the contractual disclosure facility. If you come forward voluntarily, penalties can sometimes be as low as 0, or typically between 10 and 20% of the tax owed. If HMRC finds the problem first, penalties can be 30% or higher. Step 4 is to get professional help if you need it. If your tax affairs are complicated, if you've got multiple years of undeclared income, or if you're just not confident handling this yourself, hire a qualified tax advisor or accountant. Yes, this costs money, but it can save you far more in reduced penalties and ensures everything is done correctly. Many will offer a free initial consultation to assess your situation. Look for someone who's a chartered accountant or a member of the Chartered Institute of Taxation. Step 5 is to get organized going forward. Once you've sorted out historical issues, set up systems to keep track of your income throughout the year. Use a simple spreadsheet or even just a notebook. Every time you receive income from any source, write it down. Keep all statements and documents in a folder, either physical or digital. If you need to complete self-assessment returns, mark the deadline in your calendar and don't leave it to the last minute. The deadline for online returns is January 31st each year for the previous tax year. Step 6 is to consider setting aside money for tax as you go along. One reason pensioners get caught out is spending income without realizing some of it will be owed to HMRC. If you have income where tax isn't deducted at source, estimate roughly what you'll owe and put it in a separate savings account. That way, when the tax bill comes, you have funds available. Let me give you some specific scenarios to watch out for. If you've recently turned 66 and started receiving your state pension, your tax position has likely changed significantly. The state pension alone might not push you over the personal allowance, but combined with other income, it might. Make sure your tax codes have been updated correctly. If you've used pension freedoms to access your pension pot, particularly if you took a large lump sum, check whether you were taxed correctly and whether you need to complete a tax return. The emergency tax codes often used for pension withdrawals are frequently wrong. If you have savings accounts with different banks and building societies, add up all the interest you're receiving. You might not realize you've exceeded your personal savings allowance if the interest is split across multiple accounts. If you've done any work or consulting since retiring, even casual or part-time work, this is taxable income. If it's self-employed work, you definitely need to complete a tax return. If it's employed work, check that tax is being deducted correctly through pay. If you've sold any assets like a second property, shares, or valuable possessions for more than £6,000, you might have a capital gains tax liability. The annual exemption for capital gains is £3,000 for 2024 to 2025, so any gains above this are taxable and need to be declared. Now, I want to address something important. Some of you might be thinking that HMRC won't notice or that you can just hope for the best. Please don't take this approach. HMRC's systems are incredibly sophisticated now, and the chances of undeclared income going unnoticed are very low. Moreover, the consequences of being caught are much worse than coming forward voluntarily. Apart from higher penalties, you'll have the stress of dealing with a compliance investigation, and it can affect your relationship with HMRC going forward, making you more likely to face scrutiny in future years. Also, be aware that there's no statute of limitations on tax fraud. If HMRC believes you deliberately avoided tax, they can go back 20 years. For careless errors, they can usually go back 6 years. Either way, that's a long time for penalties and interest to accumulate. The good news is that if you take action now, you can avoid these problems entirely. Most pensioners who face these charges aren't criminals or tax cheats. They're honest people who made mistakes or didn't understand the rules. HMRC knows this, and if you come forward voluntarily and show you're trying to put things right, they're generally reasonable to deal with. Right, we've covered a lot of ground today, and I hope this has given you a clear understanding of what's happening with these HMRC charges, and more importantly, what you can do about it. The key takeaway is this: don't bury your head in the sand. If you think there might be an issue with your tax affairs, deal with it now. The problem won't go away, and it'll only get more expensive the longer you leave it. If you found this video helpful, please smash that like button and share it with friends, family members, or anyone else over 65 who might be affected by these changes. The more pensioners who know about this and take action, the fewer people will face unexpected bills and penalties. Knowledge really is power when it comes to protecting your retirement income. Drop a comment below and let me know your situation. Have you been contacted by HMRC? Are you worried about undeclared income? Do you have questions about anything I've covered today? I read every comment and I'll do my best to point you in the right direction. Remember though, I can give general guidance, but for specific advice on your personal circumstances, you'll need to speak to a qualified tax professional. If you haven't already, subscribe to UK Pension Hub and hit that notification bell so you never miss an update. We post new videos every week covering pensions, tax, retirement planning, state benefits, and everything else you need to know to maximize your income in retirement and keep more money in your pocket. Check out the playlist in the description for more videos on tax-efficient strategies and avoiding HMRC penalties. Before you go, I want to remind you of the action steps. Gather your financial information, check if you have any undeclared income, come forward voluntarily if you discover issues, get professional help if needed, and get organized going forward. These 5 steps could save you thousands of pounds and give you peace of mind that your tax affairs are in order. Remember, you've worked hard all your life and you deserve to enjoy your retirement without the stress of unexpected tax bills. Take control of your tax situation now and you'll be able to relax knowing that you've got nothing to worry about from HMRC. Thanks so much for watching today's video. Take care of your finances, stay informed, and I'll see you in the next video, where we'll be covering more essential topics to help you protect and grow your retirement income. Until then, this is UK Pension Hub, your trusted source for pension and retirement advice. Stay safe, stay smart, and keep more of what's yours.